Welcome to our 2021 webinar series. LLIS believes that in 2021, knowledge is key. Each month, you'll learn key insurance solutions to better your insurance knowledge. Our insurance specialists keep up to the constant changes in the insurance industry, especially during a pandemic. Our specialists will review some basic, use case studies to show how LLIS crafted risk management strategies and answer your insurance-related questions. Each webinar will last about 50 minutes, and you must be logged on for a full 50 minutes to receive CFP credit. Please be sure to ask questions as you have them by typing them into the questions box. We'll answer all questions at the end of the presentation. This webinar is being recorded and will be posted on our website in case you missed it. This month, we have two presenters. One has paved her way to covering various types of disability and critical illness insurance. The other is constantly monitoring the insurance and financial services industry. Both ensure you and your clients are getting the most up-to-date recommendation. Please welcome Kathy Bilodeau and Mark Maurer. Take it away, Kathy.
Well, thank you, Claudia, and good afternoon, everyone, and thank you so much for tuning in this afternoon. As many of you already know, we offer disability insurance on an individual basis, oftentimes to supplement your client's group coverage. We also offer business owner disability, specialty disability for those people that have clients that have unusual occupations, such as professional athletes, or those attorneys, physicians that are making, millions of dollars and they're difficult to insure, all the way up to the maximum. And we also offer group disability. So today I'm going to be reviewing some of the riders associated with these types of plans, as well as touching on some riders associated with critical illness insurance. And for those of you who don't know what critical illness insurance is, you're going to be learning about that today too. So the first thing we're going to talk about is no-cost disability insurance riders. Then we're going to go into optional cost disability insurance riders, and then finally critical illness riders. So disability riders, there are riders and features that are built into a disability plan, and there is no direct cost associated with them. So I thought we would go over those first. So the first one we're going to talk about is waiver of premium. And what waiver of premium is it just simply means that while your client is on a disability claim, they do not have to pay the premium on the policy. That's a built-in feature. Now, another one that's built in is what we call the survivor benefit. And the survivor benefit means that if your client were to pass away while on a disability claim benefit, their beneficiary will receive 3 times, and this is average, 3 times the monthly benefit. So if it was $5,000, they're going to get $15,000. Another no-cost rider, and I group these all together simply because they all relate to a body part or a joint or something, similar to that. So the first one is what we call our accidental dismemberment, and I'm sure you've heard of this relating to life insurance. What this one says is it will pay a lump sum for the dismemberment of a hand or foot with regard to your client. Another one that's kind of similar to that is the capital sum benefit. This one pays for the loss of sight in one eye or the use of that hand or foot. And then finally, the presumptive. And the presumptive disability benefit simply means that if your client loses speech, the ability to speak, or hearing, or the ability to see, or the use of both hands or both feet, or one hand or one foot, and it's permanent, they do not have to satisfy the elimination period. Now, that's kind of across the board. We do have one carrier that it doesn't have to be permanent and irrecoverable, so it just depends upon the carrier. But that's what the presumptive means. So let's keep going into some other no-cost riders. And lots of times what a carrier will do is they'll create a rider or a feature that is very specific to them. And they use it as a marketing tool to kind of differentiate themselves from their competitor. So I thought it would be cool to bring those to the table so you could see these. And I have a little story to tell you about one of them. So the first one is called the supplemental health rider. And this one is for a client that they can receive it once in the lifetime of their policy, and it's essentially 6 times the monthly benefit in the event that your client is diagnosed with coronary artery bypass graft surgery, otherwise known as CABG. So that's if your client, has had a heart attack or has had a stroke, and they're going to need that particular surgery. They would be eligible to receive 6 months of their benefit simply because they've had these conditions. Now, another one is called the family care benefit. And this one really isn't payable because the client is disabled, but rather they're taking care of a loved one who may not be disabled but is sick. And what this one says is that if the client is taking time off of work and is working 20% fewer hours and is also losing 20% of their income, they're going to be eligible to receive a benefit of 6 times the monthly benefit on their disability plan. And they can claim this 2 times during the life of the policy. And I think where this one comes into play is I had a situation where a client, we were showing our usual carriers, and one of the services that LLIS provides is we talk through the features and the riders of the various disability plans to make sure we're matching the right plan for your particular client's needs. And this woman was an only child, and she told me the story about how she had to take time off of work and actually did an FMLA to take care of her sickly mother until her mother finally passed away. And this family care benefit really was attractive to her because her dad is still alive. And again, as an only child, she says, watch, I'll be doing the exact same thing with him. And if I have this feature on my plan, this will give me peace of mind knowing that I will be able to utilize this benefit. And so it made it really easy for her to decide which carrier she wanted to go with because of this particular rider. So let's move on to an example of 2 more riders. And again, kind of differentiating themselves. This one's called the serious illness benefit. And this one says that if your client is totally disabled due to cancer, stroke, or a heart attack, the benefit isn't as grandiose, but they can get 50% of their monthly benefit for 12 months or 100% for 6 months, if you kind of look at it that way. And they can do that one time during the life of the policy. And here's another one. Maybe you had a lot of clients who experienced this last year, unemployment. So if your client should become unemployed and they're receiving at least 8 weeks of some sort of governmental unemployment benefits, and the policy has been enforced for at least a year, they would be able to suspend the premium payments on their disability policy. Okay, so we've talked about all the definitive no-cost riders. Now there's some riders that kind of straddle cost and no cost, and that one is the own occupation rider. And this one is because it can be built into a disability policy or it can be a rider that you have to purchase. It's just going to depend upon the carrier. And for those of you who don't know what the own occupation rider is, the own occupation rider says that if your client cannot do the substantial and material duties of their occupation, and they choose to, they don't have to, but they choose to work in another occupation, they can collect 100% of the income from that new occupation plus 100% of their disability benefit. So that's the really sought after definition for certain occupations, particularly your physicians, your attorneys, scientists, veterinarians. Okay, so we've talked about all the no-cost riders. We talked about this one that can straddle both. Now we're going to talk about the cost riders. And the first rider we're going to talk about are the riders that we normally will put on a disability plan because LLIS feels that these are really important. And this first one, particularly for your clients who are in their 30s, 40s, and low 50s, it's the future increase option rider. And that's a generic term because each company calls it something different. But essentially, it's the rider that allows your client to increase their monthly benefit as their income goes up. And this is great because when your client is on that upward trajectory, you want to make sure that monthly benefit isn't remaining stagnant, that it's keeping up with their increases in pay, their bonuses, things like that. And the great thing about this is it's not medical underwriting. It's simply financial underwriting. So they're going to have to prove what their income is. Another one, which I feel is one of the most important riders on a disability plan, is what we call residual, or some carriers call it partial. And essentially, if the doctor doesn't deem your client totally disabled, this one allows your client to dip into the disability policy if they're losing 15 to 20% of their income, and it helps make up the shortfall. And some people can be on a partial or residual claim for the rest of their life. So if your client is diagnosed with like an autoimmune disorder, multiple sclerosis, fibromyalgia, arthritis, lupus, where they'll never maybe be able to work full time again, this is a nice feature to make sure that they have access to benefits. Another one is the COLA rider, or what we call the cost of living adjustment rider. And this one only kicks in at claim time. So there has to be a mechanism to keep up with the monthly benefit increasing with inflation. And sometimes it can be a fixed increase, or it can be attached to the consumer price index. And sometimes it can be compounding. So just keep in mind, on claim, if someone's got a benefit of 5,000, you don't want that 5,000 staying 5,000 for 3, 4, 5, 6 years as the cost of goods is going up. So there's the mechanism to keep up with inflation. And the last one, my little meow, my cat rider. The cat rider is a benefit that has a dollar amount associated with it, and you can take the maximum amount, or you can dial it down. So if your client likes the features of it but doesn't want that total amount, that's fine. But it's paid on top of their regular base benefit. So if they've got $5,000 of base and they have $2,500 of cat, and their triggers are eligible, then they're going to get $7,500. So let's talk about the triggers. And this is how I normally explain it. So there's 3 categories of triggers for CAT. The first one is if your client suffers a brain injury or an impairment, and that would come under stroke, Alzheimer's, dementia, and any kind of brain impairment. The second trigger is those of you who are familiar with activities of daily living, you're bathing, you're dressing, you're toileting, transferring from bed to chair, your continence, you're eating. If your client loses 2 or more of those, there's the trigger. And then the third category is more physical. Simply says if you lose an arm and a leg, or both arms and both legs, the ability to speak, vision out of both eyes, or hearing out of both ears, similar to the presumptive, you're eligible. The purpose of the cat rider is simply this. If you're catastrophically disabled, you're probably not going to be able to work in any occupation, and you're probably going to need to have someone come in to take care of you if you can't bathe or dress or feed yourself. It also helps to offset some of the additional medical bills that you're going to have, or if you need to make modifications to your home because now you're visually impaired. So that's the purpose of the cat rider. And on this next slide, I want to go into the thought process of why someone might think the cat rider is great. So the first one is they have now, with some carriers, raised the benefit to $12,500 for the maximum cat benefit, in addition to that base benefit. And it's going to depend upon what your base benefit is as to how much cat rider you can get. The second thing is if you have clients who have a family history, or even if they have a neighbor or friends that have experienced heart disease, high blood pressure, or stroke, this might get them thinking like, maybe I should take a look at that cat rider. And then the last one is if they know of anybody who's had early onset of Alzheimer's or dementia, this might get their brain thinking like, this one I need to take a little bit more seriously. Maybe I won't take the maximum, but maybe I'll take a little bit. Okay. So now we're going to talk about what I call riders and or programs. So carriers recognize that there are individuals that are going to be furthering their education, for a specific career path. So it might be, a doctor, it might be a dentist, it might be a veterinarian, it might be, an engineer. And if they're going to further their career, chances are they're going to have to take out student loans to pay for that education. And the last thing you want to do is encourage your clients to co-sign a loan, a government-backed loan particularly, because there's no way to get rid of that. So if a client has a child who is going to go into one of these career paths, you might want to talk to them about getting the student loan rider on a disability policy. And what this one does is it simply says that in the event the client becomes disabled, they don't have to worry about trying to take their disability benefit and put it a portion of it towards paying off their loan. This is paid independently. So they don't even see this money, as a matter of fact. So what it's available for is an undergraduate or a graduate degree. It can be a government-backed loan or a bank-backed loan. It cannot be what's the word, a jumbled loan. So you can't have a whole bunch of different stuff in there. It has to be a dedicated student loan for education. And the reimbursement can be anywhere from $500 to $2,500 a month, depending upon the type of degree that you're pursuing. And if your client pays their loan off early, we can just stop this rider. This is not something that has got to go on and on and on. The reason I bring that up is because this is the duration that we could run this rider. So if your client is between the ages of 18 and 40, we can do it for 10 to 15 years. And if you got one of those late comers, that's starting a new career after age 40, then we could do it for 10 years. The elimination period, there is no choice. It's either 90 or 180. This one does not have the option for a graded premium, a little bit lower, because it's literally pennies on the dollar to begin with. So it can only be a level premium, and it's reimbursement, or it can be assigned. So I'll explain reimbursement. If your client has a loan that's due, and let's say it's $1,000, and they're disabled, they're going to send paperwork in that they paid that loan for that month, and then the insurance company, by virtue of that claim, is going to reimburse them $1,000. And then in theory, they're going to take that $1,000 and they're going to use it to pay the next month's loan. Or you can assign it directly to the vendor that holds the loan, and behind the scenes, they're going to just go ahead and automatically pay that from one month to the next. Okay? So just keep that in mind when you have your doctor, dentist, veterinarian, scientists, attorneys, that are further their education. This is something to consider. So we all know, and if you don't, I'm going to tell you, most disabilities are illness related, not injury related. So approximately 95%, depending upon the statistic, some say 90, some say 95, are illness related and not injury related. But in certain occupations, I think that are more physically demanding, there's a greater likelihood that someone could become injured. For instance, if you work in the construction industry, I think injuries are going to be a lot more common. So I wanted to throw this one in here because I thought this could be kind of cool. In the event we have a client who's working in that type of industry. And what this one is it's called the retroactive injury benefit rider. And what this says is it'll pay a lump sum if the injury that caused the insured to be totally disabled within 30 days of the injury. So within 30 days of the injury, it's determined that they're going to be totally disabled. What they're going to do is they're going to go back and pay, whatever their elimination period was, they're going to pay that monthly benefit. So if someone had a monthly benefit of $5,000 and they had an elimination period of 3 months, or what we would call 90 days, they're going to get a lump sum benefit of $15,000. And obviously, they can do whatever they want with that. They can help offset some of their medical bills. They can, go on vacation with it. They can do whatever they want with it. But I just thought this one would be kind of interesting since we're always looking at the illness-related ones. So we've talked about, regular disability. We talked about having a student loan. But I wanted to touch on this one because I know most of you advisors obviously work on a retirement plan for your clients. And I think it's really important to think about, well, what if that person becomes disabled? What happens to that grandiose retirement plan that you've been putting together for your client? Well, the retirement protection plan, or what we call RPP, is here to sort of emulate what would be happening in the event that your client becomes disabled. So the way this works is it can be a rider for certain carriers, or it can be a standalone policy. And what it is it's a set amount that's put into trust in your client's name, and there are some various funds available that you would invest in. And every month, behind the scenes, again, they're not even going to see this, this money is going to be invested for their retirement. So they're not trying to pull money out of their monthly disability benefit that they're paying their groceries and their mortgage and their car loan and trying to siphon off a piece of that to invest for their retirement. This is automatically going to be doing it behind the scenes. And then in theory, this is non-qualified money. So it's not like, it's kind of like a 401k. It's kind of like an IRA, but it's not qualified. But it's going to work the same way where it's going to be, getting a higher value. The difference is your client will get a 1099 at the end of every year because they're going to have to pay taxes on the interest income or the capital gains on it. So that's where it's a little different than qualified. But at the end of their disability, when they go into retirement phase, this money will be essentially tax free to them. Okay. And that one I know is a little complicated, so feel free to shoot me an email or call me, and we could talk about it a little bit more. The next one that I want to talk about is the business loan rider. So we've talked about situations where individuals, people who are further in their education, those new professionals getting their student loans, and then we just talked about what happens with a retirement plan. Well, I want to address business owners because we have a lot of advisors who have business owner clients, and I think it's really important that we address their particular needs and their issues. So, with business owners, we have 4 or 5 different disability products available to them. So, one of them is called the Business Overhead Expense Disability Policy. And what it does is it works just like their own individual disability, which, as I mentioned, pays for their mortgage, pays for their student loan, or pays for their kids' student loans if they need to, groceries, car loans, whatever the case may be. Well, if you have a business, you have similar expenses. You might have salaries, you might have rent, you might have utilities, you might have professional dues, you're going to have computer expenses, all that kind of stuff. But what if you have that plus you've taken out a business loan? So your client has taken out a business loan maybe for additional inventory, maybe for property, might be for just expanding their business, whatever the case may be. That business loan has to be paid. And rather than trying to siphon it off from their individual disability benefits, the business loan rider is going to help with that situation. So if they've taken on a loan for 10 or 15 years and it's a certain amount, that's what this is going to do. So behind the scenes, this one again can be assigned and it can be paid directly to the vendor. And the same thing with the student loan. If this should get paid off earlier, then we can always, stop the policy, or if it's a rider, we can remove the rider from the policy. Okay. So I've talked about all the bells and whistles with disability, and now I kind of want to dive into critical illness. And for those of you who don't know what critical illness is, it was created back in the 80s by 2 heart transplant surgeons over in South Africa. And what they found out is they did a great job of healing these people and their hearts, but they didn't thrive afterwards. It's because these individuals were out of work and they had all these bills, and then they had all these medical bills. And so these 2 doctors kind of put their heads together and said, well, what can we do to help? And voila, critical care, as it was called back then, was created. Now they call it critical illness. And it's an insurance plan specifically for very serious medical conditions. I've listed some here. And what it does is it pays a lump sum tax free because you're paying for these benefits with after tax dollars. So it's a lump sum that you can do whatever you want with it. So these are some examples of what the conditions are, and you can get it from $5,000 to as much as $500,000. Okay. And then with the particular carrier that we're using, you can actually collect on every single one of these conditions as long as there's 6 months between each diagnosis. So I think that's phenomenal. It isn't like a one and done. Okay, I had my heart attack, I got my 100,000. All right, I'm done. No, if God forbid you had a stroke, 6 months later, you get another 100,000. So I think it's something that we use it primarily with individuals who do not have an income, So if you've got that client who's the high wage earner and they're concerned about the stay-at-home spouse and something happens to them, this is an opportunity where you could get a lump sum on them, and that way the high wage earner could hire a nanny or a housekeeper or someone to take care of the home front while the spouse is recovering from whatever it is that they were struck with. Another way we use it is people who are waiting for Medicare to kick in, individuals who want to have something to cover that elimination period for a long-term care policy, either that 90-day or 180-day. Individuals who are maxed out on their individual disability, they can't get any more. So this is another layer of protection that they feel like, okay, worst case scenario. And then another one is hard to insure occupations. So some people have a disability, or excuse me, have an occupation, have an income, but disability insurance is just not available to them because of that type of occupation. Okay. So these are the riders associated with critical illness. The first one is waiver of premium, very similar to the disability, but this one you pay for. So essentially, if you have a disability policy and you're on claim, this one says that they will refund your premiums if it's determined that you have a total disability and it's existed for at least 6 consecutive months. They're going to go back and pay your premium while you were paying for it to make up for the fact that it was determined that you were totally disabled. Okay. And another one is loss of independent living rider. So this one's very similar to the loss of 2 or more ADLs. So they'll pay a benefit of 25% of the benefit amount. So if it was $100,000, they'll pay 25%. If the client has a permanent inability to perform 2 or more of those ADLs, and the only 2 prerequisites are that it has to have happened for at least 180 days. So if they can't feed or dress themselves and bathe for at least 180 days, that's one trigger. And the policy has to have been enforced for at least 30 days. So you can't buy it and then 15, days later go, okay, I wanna use this loss of independent living rider. Okay. And then the last thing I want to talk about is critical illness. You can put a rider on there to cover your spouse or to cover your children. And the reason I wanted to bring this up is because women pay less for life insurance than men do, because men have a tendency to die before the term is up. So a claim has to be paid, where women have a tendency to outlive that. So we pay more for disability, women do, but we pay less for life insurance. And what I have found is if we use the woman as the main insured and we rider the husband, it's a little bit more economically affordable, because if they're close in age, it just tends to work out better than if you put the husband as the main one and the wife as the spouse. So just want to throw that out there. Okay. So I covered everything that you can do about disability, everything that we could do with, the business, retirement, student loan, and finally critical illness. And now I think it's Mark's turn to talk about all the different features and riders on life insurance and long-term care. And before we do that, I think I'm going to see if I have any questions to answer. Claudia, do we have any questions? Any questions? No questions? Okay, then I think we'll turn it over to Mark.
I don't see any, so I will thank you so much. And I'm gonna figure out how to switch our views. Show my screen to me.
Okay, there you go.
There we go.
All right.
And
you want to get to the front of yours? There you go.
There we go.
All right. Well, you take it away, Mark.
All right. Well, thank you, Kathy. And thank you, everybody, for tuning in. And so those were all the riders, an awful lot of riders that we're talking about for disability coverage. And I'm going to talk about riders on long-term care policies and riders on life insurance policies. And I wanted to throw it into the context of what's going on in the state of Washington. And a lot of you may or may not know about what's going on in the state of Washington. And you may think, I'm not that worried about what's going on in the state of Washington. I'm in Oklahoma or New Jersey. But there's been a lot of changes at the state level and government changes and implementation of things when it comes to long-term care. And I think it's good for everybody to have an idea of what's been going on and just to know, lots of things aren't as isolated as they used to be. So for those of you who aren't familiar with this, but sometime last year, the state of Washington put together, they called it the Washington State Long-Term Care Act, I believe was the original name. And it provided every Washington resident the ability to receive up to 1 year of long-term care. Well, in hindsight, only 1 year may not be considered long. So it was 1 year of care in a long-term care setting. So they may have changed the name to the CARES Act because it's not exactly a long time as 1 year. But there it is. There's I'll get down off my soapbox there. So the Washington CARES Act created this long-term care act. How are they going to pay for it? They're going to pay for it with a 58-cent payroll tax on most people. No, not 58, 0.58% payroll tax on most W-2 employees. And what that gets you is that if you are residing in the state of Washington, if you go on claim and are eligible under the program, then you can receive up to $100 a day of benefits for up to 1 year. And the state of Washington may have the ability to increase those benefits in the future. So all of a sudden, there's a lot of people who are going to be covered under this program by a payroll tax. But initially, before it's set up, the state of Washington said some people can opt out of this program. And you have a few people like self-employed people who are able to opt out of this. So it really applies to most W-2 employees. Realistically, it's probably targeting large employers. And so most W-2 people are going to have this payroll tax, or they have the option to opt out if they have a qualifying long-term care policy. And how all that's working, the guidelines are kind of being written as things go along. But the key is that in order to be able to opt out of the payroll tax and being included in the CARES Act plan and having to pay the tax every year, you have to have a qualifying long-term care policy in force by the November 1st deadline. So why is the state of Washington doing this? Well, Medicaid is the single largest payer of long-term care services in the United States. That's the reason. Billions, 154 billion with a B. That's a whole lot of money. And so what happens is the federal government gives that money to the states, and states dole it out. And so what the state of Washington is thinking is that we have all this money that we're paying out. It takes a lot of our annual budget. It's a lot of our money that's going out of the state coffers. What if we have a way for people to put in on this? And so we're going to use this plan to help offset some of the costs that we're paying for Medicaid for care. And the state of Washington expects that by 2052, they will have saved taxpayers $3.7 billion by basically collecting payroll taxes to fund the Medicaid as compared to having paid it directly. I always thought that was kind of weird because I think you can't, how are you saving taxpayers money by adding a new tax to them? I'm not sure. It's just a different tax. But that's it. The state says we think we're going to save $3.7 billion in Medicaid outflow by collecting new revenue over here. And so the state, we all really started paying attention to this maybe March and April, and saw that November 1st, actually it was originally an earlier deadline, and the state bumped it back to November 1st because the first deadline was, I think, maybe 2 months. Most people didn't have a chance to even apply for policy. So the state put this November 1st deadline in place, and all of a sudden you have 4 or 5 million working adults in the state of Washington wondering, hey, I need a long-term care policy. You have young people who may be paying into the payroll system, paying the payroll tax for 20 or 30 years. You have people about to retire who may have been looking at long-term care to begin with. And one of the things of this program is you have to have paid in for 10 years in order to be eligible for benefits. So if you have 5 years left of work and then retire, you're not eligible for benefits under the plan, unless you happen to go, unless the reason you go out on retirement is because of a long-term care claim for most people. So there are a lot of people who are pre-retirees who aren't ever going to be eligible for benefits in the plan. So they all wanted to say, hey, let's talk about long-term care. And initially, all long-term care policies that companies had in the state of Washington were available. And that was great for a lot of people, but it also kind of caused a little bit of a problem. What's the problem? Well, a 31-year-old male could get a $50 a day long-term care policy with a 2-year benefit period and no inflation rider. And that's basically as stripped down as a long-term care policy as you can get. Can't get any lower than any of that. No shorter benefit period, no shorter daily benefit. The annual premium for this guy, $250 a year. So if we correlate what $250 is in a 0.58% payroll tax, that's the payroll tax on a $43,000 income. So all of a sudden, a lot of people are going to be able to get very small long-term care policies and have premiums that make sense for them to get a long-term care policy to be able to opt out of the tax. So what happens? As you can imagine, the insurance companies are inundated with applications. Now, the insurance companies are wondering, probably at this point, why do I even have a policy that I would offer to a 31-year-old with a $50 a day benefit, 2-year benefit period, and no inflation rider for $250 a year? I'm not sure that was, was ever something that the insurance, I believe that was never something the insurance companies wanted to have people get, but just happened to have it. Well, all of a sudden, as you all know, if you find something, if you have how do I get the smallest premium to get out of tax, people are going to find the lowest premium option. So they're inundated with policies. Lots of policies for young people, minimal benefits, that the insurance company is looking at going, this isn't really planning, this is trying to get around the payroll tax. And all of these people are really going to cancel these policies as soon as they have the ability, or as soon as they think they have the ability. And so we're going to spend all this work, effort, time getting policies in place that maybe last 1 year, 2 years. Some companies even said, we aren't going to allow monthly premiums because we think people are going to pay it until November or December and then cancel it. So they're inundated. So what they decided to do, make some changes. So on June 7th, Mutual of Omaha said, we're raising our minimum policy to $3,000 a month, so doubling it, but also requiring a inflation rider and a minimum of 3% compound inflation rider. So here's our first rider. What does that rider do? Exactly what you think it does. it's going to increase that $3,000 a month by a 3% compounding factor every year. So next year it's $3,300. The year after that, it's something higher than $3,600. So growing so that over time, if $3,000 a day gets me, it covers the cost of home health care for the month. Probably doesn't, it's probably higher than that, but using that as an example, if that $3,000 covers costs of home health care for a month, then my hope is with the inflation riders, inflation happens on everything, including long-term care expenses. The idea is that it will buy the same basket of goods whenever I happen to go on claim, whether it's 20, 30 years from now, age 85. So that's a rider. That's a rider that included, that insurance companies said, for that 31-year-old, $50 a day today is, a nice dinner out. When he's 85 in 50 some odd years, that's not going to buy a Happy Meal. So it's not really a planning policy, it's just a tax avoidance policy. And so it has sort of the desired effect. Now, that male age 31, $3,000 minimum policy, inflation rider, now the premium is $1,166. Now it's only attractive to people who have an income of $201,000 or more. People who probably will hold the policies or are more likely to hold the policies, who are more likely to need policies for true care planning, protecting assets as compared to just tax avoidance. So that raised the premiums. These are policies that now all of a sudden we've cut out a lot of people where this is interesting and it's going to stem that application flow to a certain extent. And at the same time, on June 7th, Mutual of Omaha also raised their minimum age to 40. So all of a sudden, nobody wants policies for people under 40 because they're assuming, and probably correctly, that most people are doing this for tax avoidance, not actually long-term care planning. Well, that lasted about 10 days. And on June 17th, Mutual of Omaha said, doesn't matter how old they are, we are no longer accepting applications in Washington state. Just the volume of applications to insurance companies was overwhelming in the state. If you can imagine, millions of eligible people who are working age, all looking for long-term care policies at once, all trying to apply right now. It's just overwhelming. And so on June 17th, Mutual of Omaha said, we need to basically just shut it down so that we can work on what we actually have in-house, and let's go. Oh, real quick question. What was the income break-even point for the first long-term care example in Mark's portion of the policy? So when you could get a $250 a day, $250 annual premium policy, the break-even was about $43,000 worth of income. And then it jumped to 201. So it cut out a lot of people. All right. Then, still, right now, some companies have long-term care options. Now, it can be a long-term care rider attached to the life insurance policy. That's going to be a permanent life insurance policy. It can be a universal life policy, a whole life policy, but it's going to allow the insured to accelerate/reduce the death benefit if they go on claim. And it's usually defined as something like 2%, 3%, or 4% of the face amount. So for a $250,000 policy with a 2% rider, if somebody qualifies for needing long-term care, they can start reducing the death benefit at $5,000 a month for up to 50 months. And not all riders that look like, smell like, taste like the long-term care rider qualify. We'll touch on that in just a minute, but there are certain IRS filing codes that this policy had to have, but a lot of insurance companies had this. One of the issues, though, was what state of Washington never gave any guidance on how much long-term care one should have. So while it talked about a qualifying policy and it had to meet certain IRS filing requirements on how the long-term care was, even though the state benefits are $100 a day, there was never any guidance that says you should have $100 a day. You should have at least 50. Nothing like that. So again, now that long-term care policies, our break-even is now $201,000. Where's everything going? Now all of a sudden, the waves of applications now are flowing to life insurance companies with the long-term care rider. So the rider meets the qualifications, and life insurance companies are getting inundated with all of these applications. A lot of them for $100,000 life insurance policies with the long-term care rider. And again, some younger people are able to get these policies. All of a sudden, tons of applications. And I like this from John Hancock, and I'm not going to read all of it, but on the 29th of June, effective immediately. We don't usually get effective immediately. That really means they needed to do something. Usually it can be tomorrow, it can be Friday, but effective immediately, I don't see all that often. I've seen it more with this whole Washington long-term care issue than I have for anything else. Effective immediately, raising the premium, raising the policy to $250,000. I like this last sentence. In fact, a third of last week's submission volume came just from Washington State. 1 out of 50 states became 1 out of 3 applications, with many of them for the minimum face amount. So John Hancock is overwhelmed with applications for people with $100,000 policies with the long-term care rider. Again, not necessarily policies that people are going to take, not necessarily policies that people are going to keep, or they may take them, but they're not going to keep them. It's not necessarily going to be, and the cost to underwriting and issuing just isn't there on $100,000 policies for 32-year-olds. You can do a few here and there, but that shouldn't be what you're doing mostly. And then so a little bit later, August 6th, temporarily suspend all applications with the long-term care rider in Washington. Raised it from 100 to 250, and at some point, we're good, we're full. So what did other companies do? And I like this boat picture. My dad has the phrase, how do you make changes? Well, you can either raise the bridge or lower the river. When you look at that picture and think about that, you'll see how it makes sense. But insurance company said, we have required minimum premiums. Mutual of Omaha said, we have required benefits. Other companies said, we have required minimum premiums. Don't care necessarily how you do it, but you may have to have an annual premium of $2,000, $3,000 in the state of Washington. Cutoff dates. As of this date, we are stopping policies with this sort of option. Stopping policies altogether. Recommended submission dates. Nationwide has a life long-term care hybrid policy, and they sent out a notice last week that said, we are prioritizing applications received in the home office prior to August 6th. We understand we're still going to get applications, but they felt that with the volume that they had, they needed to pick a point where they're prioritizing applications to try to get them in place and in force between then and November 1st. To an extreme, they may not even accept applications in Washington on October 15th, or they might. But letting people know it's unlikely that at this point, if you submit them now, that they may be in place to meet the November 1st deadline. So if you're buying the policy for regular long-term care planning, that's great. We'll still accept applications. But if it's truly just sort of to meet the opt-out, may not happen. And along the way, we got lots of calls. So people have existing life insurance policies, and it may have some different riders already attached to it. So the easiest thing, of course, is to say, well, do I have to buy a new policy? Maybe my existing policy already has that. So what are some of the existing riders on life insurance policies that I got questions about? The waiver of premium rider. This is a rider on a life insurance policy that waives the cost of the premiums, maybe either waives the premiums, pays the premiums, waives the cost of insurance, if the insured is disabled and unable to work. You have to add this to a policy, so it has an extra premium. Not surprisingly, it doesn't sound like long-term care, so it does not meet the long-term care requirement. So having a term policy with a waiver of premium rider on it, doesn't count. Again, we might all expect that, but people just wanted to double check. How about other riders? Well, there are lots of other riders that you can add to a life insurance policy that lets the insured access part of the death benefit early in certain scenarios, certain examples. And it can be for terminal illness. It can be if someone's chronically ill, or even a specified medical condition based on whatever the language is in the policy. And I liked how one insurance company said this. You can use the funds for any purpose, to cover medical care costs, or perhaps even to take the trip of a lifetime. So, lots of the get the money from the policy for certain triggers, but what you do with it is completely up to you. So I had this, and this question came up. I have this terminal illness rider on my life insurance policy. Does that count? So what is a terminal illness rider? Policy states that if a client, the insured is expected to die within 12 to 24 months based on the state, then you can accelerate or get part of the death benefit early. And a common amounts, there's usually a percentage of the death benefit and a total cap. So a fairly common one is 50% of the death benefit not to exceed $500,000. So for someone who has $1 million life insurance policy, they're expected to die within the next 9 months. They may be able to accelerate $500,000 of that policy. This is a no-cost rider. It's not something you pay for. It's not even something you elect. It's built into policies and states where it's available. It's just built into as part of the policy. But it does not meet the long-term care requirement. It's not a long-term care rider. It's a terminal illness rider, so it doesn't qualify. How about a critical illness or specified illness rider? And these riders can be included on a term policy, a permanent policy, and they list specific issues: stroke, your first heart attack, end-stage renal failure, very kind of specific things. It says if you have one of these things, we need a doctor's note, but then you can advance some part of your death benefit. Again, these are going to be much smaller amounts. So this company can advance 10% of the face amount with a $25,000 maximum. So if the insured is diagnosed with end-stage renal failure, my same $1 million policy that I talked about with the terminal illness person, $1 million, it can only get $25,000 of it because that came first, 10% or 25, whichever one comes first. This can be included with some policies, just built into their base policy. And some companies have 2 life insurance versions or even 2 term versions that include this. Transamerica, for one example, has a traditional term policy and then a Transamerica LB, or living benefit policy, and it has this as a rider, and it has an extra premium compared to their base term policy. But again, it's not long-term care, and this rider also does not meet the long-term care requirement. How about a chronic illness rider? This is the hardest one because it sounds like long-term care, and for most people, when they actually go to qualify or try to apply for benefits, the triggers are the same. 2 of 6, an ability to perform 2 of 6 activities daily living without substantial assistance. 6 activities daily living are the same with long-term care. So the triggers and the way it works are almost exactly the same. But you have, when you apply and file these riders, there's different IRS, IRC sections. And the true long-term care rider, I think, is a 7702B. And with the chronic illness riders, it's a 101 and some letter. So they work very similarly. But depending on how it's filed, and I think that the The 101 is filed more often on just traditional life insurance or term riders as an ability to add on it as compared to really truly calling it a long-term care policy. The chronic illness rider, it's filed differently and it's very similar, but it's not exactly the same. And a lot of times it's not clear in the policy which option the insurance company filed under. So I had to check with a few different companies on this to see if someone's policy, how it met. Did it meet the chronic illness or the long-term care? This can be included on some term policies as well. If it's classified as chronic illness under that, I think it's a 101, 101C, I think it was, or 101.3, it does not meet the long-term care requirement. So the state of Washington said it has to be under this Internal Revenue filing code to qualify as long-term care. So to the client, the way it works looks an awful lot like long-term care, same triggers, we'll get money, etc. But at least from the state of Washington, does the chronic illness rider meet the long-term care rider? It didn't. So covered lots of riders there about on long-term care policies, on life insurance policies. I think, but I wanted to use that all in the context of Washington State, because people in Washington, advisors in Washington, you've been dealing with this a lot. For everyone else, is the Washington State long-term care program going to be a blueprint, or is it going to be a one-hit wonder? You're wondering what that was. Eddie Murphy, one of the greatest comedians of all time, had one hit. Anybody remember? My girl wants to party all the time. You know, we all know the song. Eddie Murphy, he's awesome, but you know, just did not break through as a performing singer. Weather Girls, It's Raining Men, Come on Eileen, Dexy's Midnight Runners, one-hit wonders. And the state of Washington may be exactly that. Or it may be a blueprint, a template for other states who watched what happened, saw confusion, hurry-ups, and may decide to say, we're going to implement this, but maybe don't let people opt out, or you already have to have a policy in place. I don't know, but Washington was 1 out of 50 states. And thank you for my singing. Thank you for being kind. How about that? Being kind on my singing prowess or lack thereof. Oh, I could do 80s. I could do 80s one-hit wonders all day long. Maybe that's what we'll do for our next webinar. Just 80s one-hit wonders. I don't think we can get CFP-CE for that, so we'll have to stick with insurance. But why are we looking at this? In the 1980s, there were 4 original long-term care partnership states, where in a partnership allows you to have a long-term care policy, and if you go on claim, you receive benefits, you can exclude some of those benefits, you can exclude assets or protect assets from Medicaid spend down. In the 1980s, there were 4 states: California, New York, Indiana, California. Did I say California twice? 4 states anyway. And then nothing for many, many years. And then in 2006, there's what's known as the DRA Long-Term Care Partnership Program. Not exactly the same, but a very similar program that if you have a qualifying long-term care policy, you can exclude benefits. You can exclude benefits paid from being counted towards Medicaid spend down assets. As of my last count, 43 states, including the original 4, have some version of that long-term care partnership. Now, it took a long time, but if we look at one state looking at saving $3.7 billion by adding a payroll tax for a long-term care CARES Act, it's very possible that we'll see another one of the 50 states do it at some point in the future. So those were all of my writers. Thank you again for being kind about my singing. Just to cover the last few things, we have a few conferences scheduled for the end of the year, and hope to see all of you there. Please come say hi to Jerry and Jill, who will be at NAPFA, ACP, and the XYPN conferences later this year. Fingers crossed, and I sure hope that we're able to do our Insurance Academy this coming up year. It's scheduled for February 23rd through 25th. It's in Florida in February on the beach. So come down, come to the Academy. We weren't able to do it for 2021. We were able to do it 2020, and I'm super excited and hopeful that we're going to be able to get together again in a few months. And so for those of you who are new to LLIS, we do a David Letterman top 10 things that make us different. We do free monthly webinars for CFP CE credits every month. We have a few more coming up through the rest of the year. We aren't your competition. Our only clients are family advisors. All we do is insurance, and we work really hard to save you time and your clients money when looking at existing policies or applying for new coverage. We do a lot of pre-underwriting to avoid surprises along the way, and there's a lot of really good information on our website for all of you. And we're proud sponsors of all of the fee-only planning groups that we work with. It's a wonderful group of people to work with, and a very resilient group of people, and over the last year and a half, couldn't have been happier to work with such great people. Here in our company, we have specialists in life insurance, disability, long-term care, annuities, the hybrid life long-term care options, and we're here for the life of the policy. So we help manage your clients' policies now and in the future with our advanced premium emails, our notification of term expiration, or our note emails. So try to make sure that nothing, it takes a lot of time and effort to get a policy in place, and we work hard to make sure that they stay in place. And we have our online portal for advisors, clients to look into status of applications, your client's information, and we're always revising that, always trying to update it. So any tips, recommendations, would-be nices, feel free to send those to me, and we're always happy to see what we can do. And I've had my questions. I don't see any more. I don't see any that came through from Kathy. And we've hit our time. So thank you everybody for tuning in. Thank you so much for listening. And we will talk to you all next month. Thanks so much.